Thanks very much, everyone. Good to be here today for Techweek Chicago. So we have a great panel assembled, as you can see. Why don't I invite each of the panelists to come up and introduce themselves? Come have a seat, and we'll go in order, starting with George. Or actually, why don't we start with Brad, since everybody...
Brad came in a suit, so Brad's got to go first.
Brad Purdy, I'm the COO of Outcome Health. Excited to be here and tell you a little bit about our business and our acquisition. We acquired a business that was really the only competitor in our space at the end of 2016, and have plenty of war stories from that and the integration to date.
And my name is Matt Moog. I'm CEO of Power Reviews. We're a software as a service company working with e-commerce retailers and brands around the world.
David Lyons, CEO of Orange. We're a digital advice platform, B2B service for financial advisors to work better with their clients and prospective clients.
My name is George Boussis, founder and CEO at Raise. Most know us as building the world's largest marketplace for gift cards, doing a ton around prepaid and retail technology now as part of kind of our grand vision and strategy.
So I think as we'll dive into a little bit more for each of these companies, a little bit unique for many private companies, M&A has been an important part of their growth strategy, or at least their history. Maybe we'll reverse order this time, start with George, talk a little bit about the significance to M&A to the growth of your business and where you're at today, and in general, any high-level takeaways from those experiences for the audience.
Sure, so we've actually acquired two companies now. One was actually local here in Chicago. It's called Techweek Technologies. They basically built technology for retailers and malls to better understand customer behavior, what stores they were interested in, and how they could essentially convince someone to go to another store, or give them an offer, or do something like that. And it was extremely relevant to what we were doing around personalization, around better understanding behavior, customer journey, what stores our customers were interested in. So it fit really well together. I actually happen to be good friends with the founder. We started our businesses around the same time. And just so much as it was about the company, it was even more about the team. They had built an incredible team, specifically in engineering and in product, that we thought was incredibly valuable and understood our vision and our strategy, and that they would go really well with our business. And so ended up making that acquisition, and that was incredible for us as a business. And I think what you realize the first time around is M&A is really hard, and it's really hard to get right. You're kind of combining two cultures together, especially at the stage where we were at as a company. They were in the earlier stage trying to figure out how to generate revenue, how to grow their business, and you kind of put that in with our business, and the next day you're one company. That was pretty tough. But the second time around, when we actually acquired a company called Slide, they're based in New York, and that's a big reason of why we're kind of expanding our presence there. We knew a lot of things kind of going into it that we didn't necessarily know around the first time, about further understanding how two companies would come together, how they would integrate cultures, kind of what motivated them as a business. And that was, I would say, a much better success for us as a company. But they solved a really big problem that we had, which is around mobile wallets use, driving a better customer experience. And so for M&A for us was not so much about how can we buy another company to generate more revenue or growth, contrary to probably what some other companies do in the past. It was how can we drive a better product experience, a customer experience for our members, and how could we essentially get to where we wanted to be as a company faster, knowing that it would probably take us an extra year or two to build what they had already in place.
David, go ahead. You recently made an important acquisition, Trade Warrior. Talk a little bit about that and your M&A experience.
Yeah, absolutely. So Orange, within kind of the financial advisors tech stack, really kind of sits into the front office, where Orange is helping advisors connect with more prospects, communicate, collaborate, and service their existing clients. So we had a lot of, I think, a really core focus in on kind of that front-facing experience between an advisor and an investor. As we matured a little bit and identified through our client base, they were really looking for kind of an end-to-end solution. And without getting into a ton of background around what's going on within our industry, there's a lot of innovation around automation and other types of investment solutions that really didn't exist 5 years ago. So we saw that there was a need in the marketplace, and I think much like your focus in on the making the product better, making the experience better for an advisor, they're really just kind of starting to catch up in terms of technology in comparison to other industries. So we really saw a need to really have kind of an end-to-end solution for them. Our clients are independent financial advisors, which make up really the largest segment of financial advisors in the U.S. So there's about 350,000 advisors within kind of our target market. And trading and rebalancing, which is really kind of what drew us to start to talk to Trade Warrior, which is an institutional trading and rebalancing system that's been around for about 10 years. That was an important consideration as we started to talk to them, but we actually started to talk to them as it related to kind of an integration partnership. And that, I think, just kind of naturally paved the way to where the founder of Trade Warrior and I both came out of the business as advisors. We both started, in the trenches as advisors and had a lot of similar views, and that was, kind of really how we kind of got down the path of talking about an acquisition and merging together.
Matt, Power Reviews has a very fascinating and extensive M&A history for a startup company, both acquired, divested, acquirer, acquiree. Talk a little bit about Power Reviews and the significance of M&A and how that positions the company for where you sit today.
Sure. The quick, short version of the story is I'd founded a company 11 years ago that was a ratings and reviews company, but essentially using a model of a branded destination website to collect and display reviews, more ad-supported, more like a Yelp or TripAdvisor. And 7 or so years into the business, we made a decision to start pivoting toward more of a software as a service business and working directly with brands and retailers to help them collect their own reviews and display on their own site. And just as we were making that pivot, Power Reviews came up for sale, and as Andy mentioned, it was an unusual situation where Power Reviews had been bought by their biggest competitor, and then that competitor was sued by the Department of Justice for antitrust, and then they were forced, after a 2-year-long trial, were forced to divest the company. When we bought it, it had a very small team that remained of about 1/3 the original company size, and needed to very quickly hire 100+ people and essentially restart the sales and marketing and R&D engine. Fortunately, when it was sold originally for $170 million, and we were able to buy it for $30 million, so that's a good place to start from. But it's gone very, very well since then, and we now have 160 people on the team, and the business is growing quite substantially, and we've become the market leader in the space. So it's been an interesting journey.
Brad, you just bought one of your pseudo competitors to form Outcome Health and have a burgeoning category juggernaut in the health tech segment. Talk a little bit about M&A and your experience, including the recent experiences with it.
Yeah, absolutely. Some background, Outcome Health is around delivering content and information when you're actually making decisions about your health. And if you think about the landscape in healthcare, it's never really been done before in the high leverage areas. When we look at someone with chronic disease or is making health decisions, you spend 500,000 plus minutes oftentimes living with a condition and less than an hour a year making really all of the things that impact your quality of life, your length of life, the medications you're on, and it's in your doctor's office. And so our business is around delivering technology information when you're making those decisions. And to date, built a really robust platform on acquiring physician practices organically and then delivering this technology into their offices. If you kind of think about it, the vast majority of us have never really experienced something like that before. You often walk in and you're looking at, nothing, or maybe a poster or a brochure from a physician. And that's really the problem. So when we look at our business, we look at it in an L bar. We sort of say, what are the physician practices we touch as far as the x-axis? And then what are we serving as far as technology into those offices to really change those decisions and really improve health outcomes, which is really the core mission of the business. And when we looked at that landscape, most of that, we really have to go wire up ourselves because, most of the world, there's 10 million exam rooms, and most of them have nothing. They really look like the 19th century as far as technology. There was one other business in the United States, though, that had done something like ours that was about, as far as device footprint, about 1/10 the scale as what we were, but it built a nice business, that was, about 25 years old. It was actually original spin out of, CNN and another holding company. And they're really the only other person who kind of deployed significant footprint into physician practices, serving digital content and information to improve decision making. And it was one of those unique things where, as we looked at it, it was really the only business that we could acquire to grow the x-axis and really consolidate, this footprint in the United States. But then really in the future, as we look at it, we're thinking, we've really built a robust distribution platform of delivering information, content, technology into physician practices. And more, we'll think about going vertically and, certainly partnering, but also I think buying businesses over time that can really improve physician workflow, clinical intelligence, and really our core, business as well, which is, improving how decisions are being made at the time that a patient and provider are together, both in a physical and virtual sense, making healthcare decisions.
Great. Maybe we'll take a step back for a minute and think about the M&A market environment. There have been a number of high-profile M&A deals announced recently. Just in the last few days, you had Amazon's announced acquisition of Whole Foods in the food segment. You had Walmart acquiring Bonobos in the broader retail segment. I think these are two great examples of companies grappling with some of the challenges in Whole Foods, which was the target, in Walmart, which was the acquirer, in each of their respective cases of grappling with some of the challenges of an increasingly digital and omni-channel kind of environment for retail and really for commerce overall. I think George and Matt, obviously retail is an important component of your business. David, financial services, we've seen incumbent players trying to grapple with some of the changes in digital disruption, both through organic initiatives like Goldman Sachs and their Marcus online lending offering, as well as through potential investments and partnerships with digital startups. In the health segment, Brad, we have WebMD rumored to be for sale right now, one of the big legacy players in kind of, or Web 1.0 players in digital health. So we think about this M&A environment. Are there any takeaways or implications in terms of how you think about digital disruption and M&A and what that means for your business and your outlook? We'll go back to George again.
I think it all comes down to the strategy and the long-term vision of all these businesses and what they aspire to be, or the product that they want to necessarily deliver to their customers. I think in the case of Whole Foods, for instance, I think what they realized is that, stemming from their strategy and where they saw their business going, that it was more of a 1 + 1 = 5 like transaction for them with Amazon, that they could help deliver on things that Walmart wanted to accomplish from a customer experience, whether it be delivery, whether it be supply chain, whether it be a very data-driven approach to the food business, which, I happen to have a food background, but overstock of food items and, SKU level information, supply chain, all that become massive opportunities for those businesses, and that's something that Amazon just does extraordinarily well. It's a space that they've been keen on getting involved in. It's a $600 billion a year industry in the US. And so for them, it was, I think, much more of a, visionary strategy like opportunity for them. In the case of Walmart and Bonobos, that's another example, which is consolidation in the space. And so much of it becomes about, market effects and tapping into those larger opportunities. having all that shelf space at Walmart, looking at what Mark Lowry's trying to do there after, the whole Jet Walmart deal. It all comes down to just delivering value to the consumer. And in doing so, for them specifically, it's all about, market effects, alignment, strategy. And that's similarly the way that we look at things, even though it's on a much smaller scale to what they've done in the past. But I think that's what it comes down to.
Great. David?
Yeah, I mean, in our industry, we're in a really highly regulated industry, financial services, investment management, and I think that, as it relates to the larger acquisitions, I think you really haven't seen as much activity inside our industry as you have in other industries, but there's certainly been a lot of funding put into the fintech industry, and I think that you're going to kind of continue to see that shift a little bit, where what Orange does kind of sits within a sector of fintech we call wealth tech. I won't get into the different sectors and save you guys a lot of long-windedness, but the largely, I would say, over the last handful of years, we've seen, I think, a lot of investment going into payments and loans within kind of the fintech sector. And so I think, moving forward, you're gonna start to see that kind of finding its way around different sectors within fintech. The entire kind of large ecosystem of wirehouses and large banks is obviously ripe for disruption. And the way that we think about that is that we're not going to compete with Goldman Sachs on acquiring companies, obviously. But there is a lot of really innovative startup companies that may not want to or looking for maybe more of a similar type of cultural fit and vision and kind of like a founder-led type opportunity. So we think that there will continue to be those types of opportunities within our sector.
Great. Matt?
Yeah, I think our take on the Amazon, Whole Foods, and what Walmart's doing, et cetera, is sort of there's three big macro trends sort of driving the consolidation and the acquisitions, et cetera. And one of them is just this continuing need on part of the consumer for transparency into the entire buying process, wanting more information to make decisions on the spot. And Amazon is very good at that and drives a lot of product content and reviews and other things and brings some of that discipline. The second one is, I think any company that's going to survive in this digital age needs to do a great job of listening to customers and unifying the voice of the consumer. And that's really a critical element from our point of view is how much have they baked it into their culture, into their processes, where they're constantly not only listening but responding. And in the perfect world, they're then being transparent and sharing with their own customers the feedback that they're getting. And then the third one is really just, it's the nexus of social and mobile and on demand, and just the expectations that you hit a button and a car shows up and your food shows up and you make a reservation and everything happens all at once. And these slower moving traditional companies needing to completely rethink their business, their pricing model, their logistics model to account for that. So it's those three big trends that are driving things from our point of view.
Great. Brad?
Yeah, no, absolutely. I think that what you see a little bit, both in many businesses that are being built in healthcare, as well as particularly indicative of WebMD, is that they're oftentimes focused on a very specific constituent and really don't understand the value chain of how a lot of things impact the other constituents across the landscape. And it really leads to a lot of the fragmentation that you see. When we look at our business, the main thesis that we have is that there's incredible fragmentation in the provider level. So if you look at the United States, there's no more than anyone who really has more than 1% market share of all providers. When you kind of really dig into the data, even the largest health systems, they're really kind of consortiums where people are affiliated, but they don't really control individual doctors. And then if you really look at what's happening in individual practices, if I walk in and one of you is my doctor and we're making a decision about my health, while you want to be a good doctor and you've taken an oath and I want to live healthy, we're not the economic constituents as far as what happens when the right decision is made. So really the beneficiaries of the right decisions are the payer, the services providers, so someone like a pharmacy or a PBM, or those who actually manufacture goods and services, like a consumer packaged good or life science company that is really a stakeholder in that decision. And when you look at a business like WebMD, it's pretty interesting where they've actually just focused two halves on their business on a single constituent. So most people don't understand this, or kind of don't have the background, is that half their business is actually the consumer business. It's actually a little bit less than that, the WebMD website that you know. And then the majority of their revenue actually comes from a business called Medscape, which is a physician-facing business where you go to look at clinical trials and research information. And they've really kind of targeted both in kind of a pretty disparate business on both sides. That was what we see a lot in the healthcare landscape, which is that you'll find someone who optimizes for a given constituent and really doesn't think about the value chain as well as really the way that they're going to scale the go-to-market both domestically and globally. And that's part of the reason that we're really excited about the landscape. I think fragmentation and kind of large economics generally have created some of the largest business in history. And what we've really thought is, when you go to market, you really need to understand each of those constituents, really go and build the right commercialization channels as far as going and doing that at scale. And what we're really hopeful of is hopefully being able to build some of that scale and then find some of these things that have great businesses that are starting to get traction and really then help them commercialize at scale over time, which is certainly part of the reason that we believe we'll be pretty active in M&A over time as we kind of scale up the y-axis in healthcare.
Great. We've got a couple of questions from the audience, so why don't we turn to that for a minute. Certainly one critical component of successful M&A and M&A execution is the integration of an acquisition, and including, as the audience member explicitly described in the question, technology integration. Maybe we'll start with Brad this time. Talk a little bit about your thinking around acquisition integration and specifically technology integration.
Absolutely. So this can mean certain things for different businesses. So if I were to think about us acquiring, one of the things that we're interested in as an example, which is workflow solutions to really improve physicians. This might be something like helping the physician understand what are the medications that someone is on and really making the right clinical decision. And so really understanding that technology and then what does that mean to your business and what does it mean as far as scaling that is certainly important. But if you look at what we've recently done, we acquired a business that did something pretty similar to what we did, but in a different technology stack. So when we looked at this business, they had about 20,000 remotely controlled digital devices, so commercial displays that had an embedded computer in waiting areas and tablets in exam rooms. And when we looked at this, we said, certainly this is a similar business, but it was really imperative if we were going to buy this company for us to be able to move this into a consolidated ecosystem where every device, both the ones that were, the historical outcome health devices as well as this new business's devices could be operated in a uniform way, and we weren't, kind of splitting our stack and kind of doing things different over time. And so we went through a lot of diligence up front to not only understand what did their technology look like, what would it be on an integrated basis, but also what were they doing that was potentially positive that we could then transpose into our ecosystem. And you certainly, I think, run into the classic sort of unknown unknowns. When you kind of go into something like this, you make a lot of assumptions, but then when you actually go to do it in practice, it's incredibly more difficult than I think you oftentimes imagine. And oftentimes it's really just the small decisions that have to get right every single day that are most imperative. But we've gone through this process now, and we sort of set a 6:30 deadline, so we're pretty tight on our end. But right now we're about 85% actually complete, which is kind of really a testament to our team and kind of the upfront diligence that they did, which I think more than anything is probably what a lot of people will say is the most critical to getting kind of technology and really kind of transactions right, at any scale.
Matt.
Yeah, so it's a tough question to answer in a general way, but I guess I'll give some specifics. I mean, one is I have heard of scenarios over the years where the technology was so similar and the customer base was so similar that it was basically just pick up and drop in to the new technology and phase out the new one and do it very quickly. That's a great situation if you can find it, because there's huge amount of leverage and you focus everything on one platform and it becomes a customer acquisition vehicle. In most cases, what I've seen is that you're going to have to count on onboarding the technology and over time merging the two together and phasing them out. And I guess after 20 years of doing this, I've sort of come to the realization that you're never done improving and upgrading your technology platform, and every 3 to 5 years you really need to have rewritten and re-architected and updated the entire thing. So if you acquire somebody, just sort of bringing them into that flow and bit by bit, moving customers and blending them together can be a very good sort of way to do it. What you don't get is the immediate cost savings that you would in the sort of the best case scenario. On the people side, from an integration point of view, it can be really hard, and I'm a big believer in creating a culture, ideally in one office where people can really thrive together. As you get bigger and acquire other companies and you become remote, that's a whole nother series of challenges. The company that we acquired was actually based in San Francisco, and we spent 2 years doing everything we could think of to treat them well, integrate them, bring them here. We went there, do all of our parties together, everything. And after 2 years, ultimately, and we looked at all of our internal surveys and ENPS scores, I went out there and said to them, you're clearly not happy. We're not happy. Let's find a way to wind this down and transition everything to Chicago. So that was sort of a tough thing to do, but once we did it, it had another bump of getting one cohesive culture. So I wouldn't be overly optimistic on the immediate benefit of technology integration, and I would be super conservative about the amount, just realistic about the amount of time and effort it takes to blend two cultures together and what the path to getting that done is.
David, feel free to chime in with your thoughts on that question, but also we have another question from the audience that's specifically for you that maybe you can comment on as well. The question is, Orange and Trade Warrior seem like a perfect fit for each other. How do you draw the lines of responsibility between the two companies?
Okay, so I'll try to maybe add on to the other one, but the short answer to, I think, the integration question from a technology perspective is that we're about 3 months into that. So I'll tell you in about 3 more months, but largely we did do a lot of due diligence, a lot of code review. I think we were really, really lucky to have our CTO, who has been in the trading platform business for 15 plus years. Don't want to shortchange him. And so, there were definitely technical challenges, and there continue to be technical challenges in that integration. But knowing about them, up front, and and trying things and failing quickly and pivoting on that, I think is critical to that. But essentially, what we're trying to do from an integration standpoint, a lot of companies take like 2 years to do that, like within our industry is kind of what we see, and we're trying to do that in 6 months. So I'll let you guys know in about another 3 months how that comes out. But in terms of the fit between Orange and Trade Warrior, is that kind of?
Yeah, I guess the question or comment was, they seem like a perfect fit. How do you draw the lines of responsibility between the two firms? I guess how are you integrating them from a management, from a business perspective, as well as product tech perspective, which you just alluded to?
Absolutely. I mean, so Trade Warrior, has been around for 10 years, but they've really run their business fairly lean. So coming in, we weren't, looking to kind of slim down their headcount. We're adding resources to that. In many cases, going through kind of that acquisition process, we just identified, a lot of synergies where, our head of product, is essentially now overseeing 2 products. We believe Trade Warrior is a great standalone solution. We did not look at it as a feature acquisition. There's huge growth opportunities for them within our industry, but at the same time, there is kind of that adding that feature in and kind of a cross-pollination of development teams and stakeholders. So, right now, and again, we're not hundreds of employees, we're under 100 employees, so there's not a lot of kind of butting heads at this point. And I think largely it comes down to having a shared vision, kind of around the mission. And I think that was just something that brought us together initially.
That's one of the things. There are many challenges associated with doing acquisitions as a relatively smaller private company, but it sounds like on the flip side, one thing that may make it easier is you don't necessarily need to lay off a bunch of people if you're growing and want to retain and attract talent.
That definitely makes it easier.
Okay. George, feel free to chime in on the integration topic if you'd like, but in the spirit of trying to get in a bunch of the different questions we're getting from the audience, a couple other pitches to throw at you. The first one is, at what stage in your company's growth and development did you feel like making an acquisition was actually a viable strategy? And secondly, talk a little bit about acquisition funding, how you've funded acquisitions, and how does a private company deal with that?
Sure. So, I'm sure you've heard a lot of really good things from, three gentlemen up here, and they've obviously have been really successful in doing that. I think, for us, again, kind of what Matt was saying, the challenge was on both the people side and on the technology side. You realize you can't jam both those things together and call it successful. So I think so much of that up front was done in the diligence process of just interviewing the people, better understanding the culture, the technology, the platforms, and all that, which is why that was fairly successful. And I think at the same time, giving that team ownership over the product that you think to add a ton of value in, specifically for us, it was on the wallet side with the Slide acquisition, and we actually added resources to their team, so we let them almost operate as a team within another team of our product and actually help them out in many ways. You also go into it with an open mind of realizing that you probably don't know everything and you should think about things in a different way, which is a really good thing in our case because we had thought about at the time re-architecting, rebuilding the whole app, which we were chatting about backstage, takes such a long time. But we learned a lot of things along the way, so that was great. But to specifically answer the question, I'll go off to the second one first. For us was we looked at it in a couple different ways. First acquisition we made was all equity. Obviously they had valued where we were going as a company and understood kind of the strategy, the vision, where we were headed as a business. There was a lot of alignment amongst the teams of the opportunity in the prepaid space and where we were headed as an industry. Very similar like beliefs, and so that was really easy. The second one was actually an all equity deal as well, but there were some challenges as far as some liquidity for investors that were in for a while, some preferences and terms that they had that we had to address. But again, the bulk of that was actually done via equity. Now we've looked at M&A now in the future going forward, and we're in a bit of a different position. I think, we're looking at larger acquisitions now, and some of those come with potentially having to fund what can be tens of millions or hundreds of millions of dollars. And so getting those conversations off early, speaking to everything from the banks and building relationships, whether it be in debt, whether it be cash and equity, whether it be, doing another round of fundraising to specifically fund the transaction. We just continue to look at all those things. So those are different ways that you can do it. But it comes a point in time where you really value your equity a lot as a company. And so you realize that not every deal can or should be an equity deal. And if there's more value by just paying cash for something that you can turn into exponential value for your business, you should hold on to the equity. But at the same time, culturally, we like to give as much equity as we can to our employee base, drive alignment, make them feel like there's some ownership at stake. The first one?
There was, at what stage do you feel like
Sure.
acquisition is
Yep.
viable?
I don't know if there's ever really a stage. I think for us, because every company is a bit different when you have the resources that can support the transaction, whether it be an integrations team, a corporate development team that focuses on opportunities, on diligence and whatnot. So it's until you have the infrastructure to support something like that, and it becomes more and more interesting. Now, some businesses don't believe in M&A, and they've been successful in their own ways without it. But in one way or another, if that company helps you pursue something that you otherwise haven't been able to accomplish in the past, I think keeping an open mind to it is definitely a benefit in the long term.
Great. We'll come back to Brad. Feel free to chime in on the acquisition viability and financing topics, but the spirit of trying to hit all the questions we're getting from the audience, talk about some of the key challenges that you may have faced in doing acquisitions and things that you did to overcome that, and then related, before embarking upon an acquisition, how do you analyze the potential negative aspects or risks of an acquisition, and how do you grapple with that and factor that into your decision making? And then finally, any third-party service providers that you use, lawyers, accountants, consultants, bankers?
Absolutely. To start there, what we probably thought was most challenging, there's plenty of challenges when going through it, was we were acquiring a very close competitor. It was really the only kind of true competitor that did anything like us. And so getting the right amount of information to properly diligence the business, to properly look at, what is this from a synergy standpoint, both on cost and revenue side, and then even, properly just thinking about, what to pay for it and how to finance it was the biggest challenge, just given the kind of, I would say, huge hesitation they had in giving us the information that we needed. It also probably wasn't helped by the fact that we had grown very quickly in this industry. So Outcome Health has grown over 100% on average for 6 years in a row, and so for a while they sort of thought of us as the kind of minnow in what they thought they were sort of king of the hill, or king of the small pond. And I think that they didn't believe us that we had both the ability, the willingness, and really the scale to be able to acquire them, because we also weren't going to share very much information back. In kind of going through that, we ended up financing it through a committed term loan financing. So we had 3 partners in that: J.P. Morgan, Goldman Sachs, and Citizens Bank. So they provide the financing up front to say, hey, we backstop you and your ability to pay this. And then we issued a publicly rated term loan B. It was a piece that refinanced some existing debt. And then paid the acquisition of just under $400 million in that vehicle. But getting all of that diligence right while then setting up the ability to do that with limited information, I would say it was probably the hardest piece of it. Remind me again, what was the last question you asked?
Questions around service providers.
Oh yeah, so service providers, we certainly had people who did a couple different things. So given we were doing committed financing, we did what's called a quality of earnings review on the business, which looks at their earnings, what is their EBITDA and revenue, and is it factual as far as what they're reporting. We did then some accounting reviews, both on tax and sort of any kind of historical liabilities of the business, and then primarily we're working with the legal partners, so the lawyers to actually do the purchase agreement and do any review of the legal landscape associated with the merger, as well as our financing sources, which we talked about. We interestingly didn't use a banker. Some of the people on the financing side did help us, and our lawyer throughout that was a great partner and helped us in some subsequent work at Kirkland.
Matt, chime in. Acquisition, financing, challenges, service providers, all those topics that you
Okay, sure. Yeah, so a couple of things I just think are good points to make that surround all of this is one, whether you're the entrepreneur or you work at a tech company in Chicago, one of my recommendations to you is that you and the management team make a list of the companies that you're really interested in, that are in adjacent spaces all around you, that are complementary, and you just over time get to know them. You get to know the CEO, you get to know their business, you follow them, and you build a relationship. It's almost impossible to cold call somebody out of the blue, have to introduce yourself, and then attempt to have that conversation. So there have been CEOs that I've been meeting with once or twice a year for the last 3 or 4 years to try to build those kind of relationships so that when they're ready to sell or we're ready to buy, that it's a much warmer conversation. So that would be, I think, one very important point. The second is related to the stage that I think somebody asked about. Having done acquisitions at different stages and different sizes, one overall point I want to make is that there are a lot of investment bankers, there's a lot of private equity people, there's There's a whole lake full of lawyers and everybody else, but there's not many entrepreneurs who have the vision to know exactly how the pieces come together. And usually when you're going to buy something, there's some untapped value in there that isn't super obvious to everybody else. And so whether you have no money in the bank and no investors and you think you have no ability to raise it, if you can put something together through several different pieces that make something that's exciting and different, there's a lot of different parties out there, I think, that are looking for somebody like you who see the different pieces and how they come together. It's always striking to me how, with all due respect to bankers and private equity folks, how little they know about the businesses that we run and how much they're counting on the entrepreneur to explain where it's all going and how it all comes together, and frankly, and then betting on you as the one to make it happen. There's a lot of stories out there of companies making bids on other companies without any money in the bank to pay for it, and then finding the funding after they've gotten a commitment, things like that. The outcome health story is a phenomenal one because of the scale and the success. Not everybody has all of those tier one banks lined up, but I wouldn't be shy to be super scrappy about it either. The last point I want to make is I think several people up here have made the point that acquisitions are hard. Most of them fail. It's very exciting. Makes for great cocktail chatter to talk about a company you're buying, et cetera. It makes you feel like you've hit some sort of milestone. I would just encourage you strongly to mentally visualize you and your company after the acquisition happens, and now what the hell do we do? Who's going to run sales? Will my head of sales agree to the quota that reflects everything that was in my assumptions? How are we really going to put this technology together? How do our overall goals change? And is everybody in the management team signed up for that? Have we really talked to customers about what they see as the synergy between the two? And just force yourself to become the devil's advocate or the skeptic of the deal, and look at it as more like, okay, the deal's done. Now we've got to go make something happen. What do we wish we had asked, at this point? So that's just 3 pieces of advice there.
A couple additional questions on top of some of the other topics that you've heard, David. If you're looking to get your business acquired, what do you do to kind of prep for that? And what would you look for in a potential acquirer as a startup company? Secondly, and Matt kind of touched on this, and I can probably handle it as well given my background, but if a company's under financial hardship but experiencing growth, do you think it's possible to get an acquisition funded?
Well, I think the first part of that question is how do you position yourself if you want to be acquired? How do you position
yourself for M&A as a potential exit if you're an entrepreneur with a startup company?
Keep really good books. That's usually one thing that, I don't have as much experience as some of the other panelists here, but that would be one thing that I would quickly run away from, or at least being able to get to the answers within a reasonable amount of time. I think to Matt's point too, the relationship is really key. You don't put your company up for sale on Craigslist and find an acquirer that way. There's got to be a relationship there, and there has to be a way to articulate your vision and what your long-term plan is for the business. I think are kind of critical components.
We've only got a minute left. George, any parting thoughts?
Yeah, I would just say it just takes investment, like investment in the team, investment in the process, a commitment on everyone's front as far as building the best team, having the best product, investing in amazing experience, and build an asset. And by building an asset, it's something else that somebody would value. And like what Matt was saying, it's important. It's you need to build relationships, and you need to kind of continue to have that an open dialogue there and build on those. And they happen. There's going to be interest if you're building a great product and you're doing something. But if it's a fire drill and you're just trying to sell because again, realizing that the seller always has the advantage over the buyer, and you're planning on screwing someone, whatever that works out to be, it's not going to work out.
Great. Well, I think we're just about out of time. Thanks a lot from our panelists. I think in short summary of what we heard today, M&A can be a critical component of a company's growth strategy, even for startup companies, but it's certainly fraught with many complexities and potential pitfalls, and you need to be really careful before embarking upon that as a path. Thanks very much, everyone.